borrowing from banks is likely to be much more difficult in future. Analysts believe African banks' debacle that led to a downgrade of the four big banks and Capitec will lead to tighter lending regulations. Banking shares fell today after Moody's ratings downgrade yesterday.
There's a general consensus among analysts that the downgrade by Moody's was not justified. South Africa's central bank also said in response to the downgrade that it did not agree with the reasons given by Moody's. It reiterated that the banking sector remains healthy and robust.
As an investment community, we sit here and we say we've analyzed these banks' liabilities. We've analyzed the deposits at these banks. And, we believe strongly that the big four banks in the country, big five now if we include Capitec, have got probably more secure deposit structures than African Bank had. African Bank, in our view, was an isolated incident.
These banks are extremely healthy. They are highly capitalized. Their capital adequacy ratio, in other words, the amount of assets they have in relation to their liabilities, is much higher than most banks in the world.
But Nkomo foresees more stringent lending rules.
We see more stringent rules being applied by the banks themselves. It will be tougher for people to get access to funding going forward, in my view, as banks will want to tighten their potential to lose money.
Earlier today, the banking index slid to a 5-week low. It declined 2.3%, its lowest intraday level since July 10th. Standard Bank fell about 3%, while First Rand and Barclays Africa both declined about 2% during the day. Diabo Seto, SABC News, Johannesburg.
Well, to take the matter further, I'm joined by Peter Montalto. He's an emerging market economist from Nomura Capital in London. Thanks for joining us, Peter. Now, in the case of South Africa's big four banks and Moody's decision to downgrade their credit ratings on the basis of what happened with a totally separate bank, namely African Bank, which has a totally different business model, was this a case of Moody's adding 2 and 2 and coming up with 10?
Well, I think it's really interesting seeing the local reaction of the SAB and the banks and other locals to Moody's downgrade. I think it largely misses the point, which is ultimately Moody's thought that there would be a larger level of support provided by the SAB and by regulators for senior creditors in African Bank, and so that there wouldn't be a write-down on that senior debt that's now going to be applied. Now, that might be the wrong assumption. For instance, S&P has taken a different view in the past, that actually there is more likely to be these kind of bail-ins used. The framework that the regulators are applying, the Twin Peak regulations, do allow for bailouts, has always been on the table. But it's really the removal of that certainty that is why Moody's downgraded, not because of any particular view around financial stability.
Now, in the case of Capitec, its business model is also different to African banks, but admittedly it has a strong reliance on making money from unsecured loan advances. Do you think Moody's made the right call there?
Well, I think the Capitec thing is, again, partly to do with the form of bailout around Able, but also around the slower growth they see going forwards, the stress that can cause. But Moody's have highlighted, I think it's very important to remember, that even regardless of the business exposure, Capitec's risk management system is completely different from Able. They basically vastly over-provision on underperforming loans very quickly within 3 months of a loan falling into arrears. And as such, it's very difficult actually for them to lose money and to get into the kind of trouble that Able did. They basically provisioned twice as much as Able were doing on unsecured debt. So there is the question of very different business lines and also different risk management, which is why I still think that the Capitec is a very different beast.
Now, the Reserve Bank has come out and disputed Moody's various decisions, saying that South Africa's banking system is well capitalized and robust, and indeed the sector went pretty much unscathed during the global financial crisis. Do you agree with the bank, or has it missed the point that Moody's is trying to make, do you think?
Well, I think, as I said before, I think they've missed the point about how Moody's thinks and analyses ratings, and therefore technically Moody's was justified in doing this. But equally, the SAB is correct, and even Moody's agrees with the SAB that there isn't a financial stability risk more generally from the banks in South Africa because of their capital ratios, because of the broader regulation framework that is in place as well. And of course, the big banks have a very diversified funding model, a very diversified business model as well. So that's why, for instance, I don't see this sort of feeding into the sovereign rating, because it's less about that sort of big picture financial stability issue.
Now, what's happened with African Bank, after what's happened with African Bank and the 10% haircut that is being imposed on African Bank bond holders, do you foresee international investors running a mile, or will they look at the actual loan book or the actual price, the performance of the banks before they decide to invest in those banks bond-wise?
Well, there's definitely a lot of uncertainty at the moment. There's been a lack of communication really from the curator and from the SAB as well, publicly at least, around the precise technicalities of how this write-down will occur. These are not easy things to apply. They're extremely difficult legal obstacles to get over, and how the senior creditors would have access, for instance, to any future sale proceeds from the bad book as one example. So we need a lot more clarity on that, I think, to put foreign investors' minds at ease. But you can actually see from how that foreign debt, the Swiss bonds and the dollar bonds of ABLE are trading, there is a lot of nervousness in the market. I think broadly foreign investors still do buy into this idea of stability in the South African banking system, but the nerves and the uncertainty, if you like, which can be easily corrected by further communication, is showing through in the currency as well, and hence some of that weakness that's coming through today.
Now, when Standard & Poor's downgraded the US and dethroned it of its AAA status, the other agencies did not follow suit. In this particular case, do you think they might do?
So the agencies treat basically the banking system in very different ways in how they look at government backstops and regulator backstops for the banking system. So S&P probably is less likely to, as they didn't make some of the same assumptions that Moody's did. Fitch is somewhere in between, and arguably will be more of a marginal case. So maybe there is further news to come on this from the agencies. And of course there's a larger issue of sovereign downgrades as well, which is a separate issue, but will be very much linked into growth that's going on, the MTBPS in October, ESCOM shareholder support. All these things are going on as well at the same time.
Just very quickly, Peter, you touched on ESCOM. We've had a new CEO announced, Tsadiso Matona. He's currently the DG of Public Enterprises. Will that give some confidence to the market, do you think?
Well, I think he's a good choice, basically, as a technocrat, as a sound guy who will be able to get to grips with the hugely complex operations that are ESCOM, and that's ultimately what Brian Dames did very well and managed to turn around the company to a very large degree, preventing more serious load shedding over the last few years. So I think he is a good choice from that perspective. I don't think he's going to rock the boat and suddenly talk about splitting ESCOM, floating it on the stock exchange, anything like that. But in terms of day-to-day energy security, within the huge constraints that ESCOM operates in, I think he is a very good choice.
Thank you very much for your insights. That was Peter Montalto. He's from Nomura Capital in London.